The so-called 4% rule has been around for about 30 years now, a very elevator pitch version of it. If you withdraw no more than 4% of your portfolio in the first year of retirement, adjusted for inflation every year after that, a 90% chance their savings will last about 30 years. So, roughly as long as the rule has actually been around. But economist Michael Finka tells The Street that for most, the rule is actually too conservative for human nature.
I think people should decide if they want to live better in their late 60s and 70s when you do have the physical capabilities and the cognitive capabilities to enjoy your life more. I mean, there's not a whole lot of 95-year-olds that are going on world vacations. And the fact is that you can't enjoy it as much in your 90s as you could in your 60s or 70s. So I think you should have the power to be able to choose the slope of your spending. And in reality, it does appear that people do spend less as they get older.
So let's talk about how you guys calculate withdrawal rates. Do you take a similar approach when calculating it for clients, or do you subscribe to the 4% rule?
Well, I would tell all of our listeners, first of all, to Google the independent income system. And if you Google it, you can watch our belief and methodology on how to kind of put this all together. When we look at the 4% rule, I would say just like anything, there's kind of pros and cons to it.
Mhm.
First of all, the positive is it's simple. It's a clear withdrawal rate. Number two is in this example, it has some historical basis on the success rate. They say history doesn't always repeat itself, but it oftentimes rhyme. Number three is it's building in that inflation component into it. Some of the negatives, just like what they had mentioned there when they were asking Michael his opinion, is it doesn't take everything into consideration. I would agree that when working with hundreds of families and helping them retire, it is common that many retirees will want to spend more money in their early to, you know, late 60s while they're young and traveling and doing the things that they wanted to do. And, spending can go down in the later years unless there's a healthcare related scenario that comes up. The other challenging thing I'd say in reality is I've had a lot of clients who want to set up this, kind of 4% rule, but it doesn't take into consideration life's what ifs. What if you got to help the kids out? What if the basement floods? What if you need a new car? What if this happens or what if that happens? And so in building in the plan, you want to make sure that you have a bucket of money set aside to cover those type of what ifs. I would say in almost every situation when working with a retiree, there has been other considerations on different years that do come up. Number two is you got to look at the sequence of return risk. So in this example, it's talking about a portfolio of 60-40, 60% equities, 40% bonds, or, kind of vice versa, depending upon somebody's goals and risk tolerance. But when you think about money that's all in risk-based investments, stocks and bonds that go up and down like the economy, for a retiree, it's not taking into consideration the fact that the markets are going to have downturns. We can see, both stocks and bonds go down. We saw that just recently in the last couple of years where that had happened. And so the sequence of a return risk is something that this strategy doesn't take into consideration. We just had a previous segment, and of course, we've had other segments talking about things that are non-market risk investments, talking about where traditional fixed rates are. I'm a believer, and sometimes you want to remove some of that sequence of return risk by adding in some of the more higher fixed rate products that are out there today. Can help address one of that negatives. Number three is, withdrawal strategies need to be adjusted during different market downturns as well. In our strategy that we have, the other thing that we take a look at is the potential issue of longevity risk. So when you have all of your money in at-risk investments, stocks and bonds, they always have to say past performance doesn't guarantee future results. So you have a
Mhm.
longevity risk inside of the plan. Again, I'm biased in the fact that we've put together a process where we think that the 4% rule can be something to become familiar with. It can be part of the overall plan. I'm biased. I really like what we've put together called the independent income system. So if you're a listener, the bottom line is I would tell you if you haven't had America's Retirement Headquarters put together the Retirement Team Action Plan, we can walk you through the independent income system and also show you where there could be some other opportunities to increase some of the potential that you have, maybe eliminate some of the risk and threats of what we've seen over decades of years of helping retirees get to and through retirement time. It's part of that retirement team action plan. Now, you've been doing this, also for quite some time. What is your thought process regarding the 4% rule?
Well, I came into this business when the 4% rule was like the only train of thought. Now, when I do my reading, I see that there's a lot of people that say, well, you should only withdraw 3.5%. It varies. It depends on who you're listening to. But I would add this. I think when I talk with people today, most of them feel or have the opinion that taxation of retirement benefits, money coming out of IRAs, 401ks, and those types of portfolios are going to increase during their retirement life. So the rules that exist today, a 4% withdrawal rate could be very, very simple, and it could make a very good plan of action. What about 5 and 10 year and 20 years down the road? If the government decides to tax retirement payouts to a greater degree, that could create some issues, especially when Nolan mentions longevity risk. People are living. You got a married couple, both age 65. Odds are in the favor that one of the spouses, is going to live to their 90s. So there's a lot of variables that have to be applied to the situation. So I would say that having America's Retirement Headquarters, having us take a look at your situation, will get you on a good path for what's happening right now. But most importantly, we're going to be able to make the appropriate pivots and adjustments as you proceed through your retirement life cycle.
That part, the retirement team action plan, because it is not a passive plan. It is something that, as changes warrant themselves, the changes can be made, not set in stone, not a thanks for coming in and we'll see you never, best of luck to you. No, they developed a plan to continue to maintain the plan as things may come down the line, being able to adjust them, whether it is a taxation increase, whether it is market volatility. These are some major risks that people might encounter over the course of their retirement. And the longevity risk, the longer you live, the more likely you are to encounter a major tax event or a market correction or things like that. So you want a plan that can pivot and change with you. Perhaps it is starting with the 4% rule and then readjusting down the line. Perhaps it's more of a 3.5, perhaps it's more of a 6, but it really depends on your circumstances. Sitting down and speaking with the team, start developing that retirement team action plan, including utilizing the independent income system, seeing how it can all work for you. That begins by going to the website, arhq.com, set up a time there, or you can give a call right now, set up a time, get on their calendar as well, 419-794-3030.